it feels like now really is the bottom, right? We are starting to kind of change the gears a little bit, point the car in a different direction, put the foot to the floor a little bit more and trying to get things moving again. Because as much as I bet the government would like Kiwis to invest in arguably more productive assets, Kiwis invest in property, right?
Mm-hmm.
And if the property market isn't going, really the economy isn't doing too well, right? And I would say that towards the back end of this year, start of next year, you're going to see things really take off. Welcome to Checks and Balances, brought to you by Partners Life. I'm Michael Vincent. This is James Blair, and today, LVR Changes.
We're back in your life to talk about lending changes. Now, let me tell you a little story. Once upon a time, it was a great land where you could get money to buy houses. And then, over the past 5-6 years, it's got harder and harder and harder. We've gone into a recession. Things are tough. House prices are down. But Mike, there's a little bit of good news.
This feels like the presidential debate. Like you're Trump and I'm Biden. And I'm just going to reset at some point.
Mate, at least we can walk off the stage by
That's
ourselves.
a fair point. No, there is a little bit of good news. So this has been coming for a little bit of time now, but the Reserve Bank has shifted the loan-to-value ratio restrictions on in situ or existing investment properties from 35% to 30%. Now, that in isolation doesn't sound like a huge change. However, it actually is quite a significant change, right? So if we look at the examples here, on a $900,000 investment property, you used to need $315,000 of usable equity or cash deposit to purchase the house. That's now dropped to $270,000. It's about a $45,000 difference. So although it's only a 5% difference in the required deposit, in dollar terms, it can actually make quite a significant jump.
That's actually a really good way of putting it, because I look at 5% and I go, probably not that big of a difference. The other factor you've got to think about, right? House prices keep falling. Yeah. So equity becomes less and less, which means it's harder and harder to do something. There's those poor people out there who have negative equity. Obviously, it's not going to impact them, these changes just yet. But it does make a difference, right?
And if we look at, say, the other end of the spectrum and people do have less equity, but they still want to go out and do something. Let's say you're looking at a $450,000 investment property. You used to need $157,500, so basically $160K. You now need $135,000. So a $22,500 difference. So even these incremental movements in the percentages can make a real difference in your ability to purchase an investment property. And $450K, yet we're not, that's not a central Auckland 2-bedroom townhouse with a car park, but that is a really good investment property somewhere in the regions, which probably has quite a good yield on it.
Yeah, it does make you think, right? Like if you go back and we were at 35% deposit requirements for an existing property, examples with new builds with 20% and then 10%, and new builds were very hot. Everybody wanted a new build because of the obviously interest deductibility treatment as well. It's a lot easier. Now we're looking at it and going, there's actually quite a few new builds on the plans that are struggling to sell because all of these changes are happening. And then you've got existing properties where, we're talking about debt loading, lower deposit requirements, interest deductibility. On like $1 million mortgage, you might be saving $10,000 or $20,000 a year with these interest deductibility changes. Feels like things are swinging towards the existing properties quite a bit.
Yeah, 100%. And not just swinging towards in situ or existing investment properties, but swinging towards getting the property market going again, right? And I think that's probably the wider thing of what we're talking about here is, and we preach this all the time, right? Like it's very difficult to see when things are at the bottom. And in hindsight, it's very obvious when things are at the bottom. It feels like now really is the bottom, right? We are starting to kind of change the gears a little bit, point the car in a different direction, put the foot to the floor a little bit more and trying to get things moving again. Because as much as I bet the government would like Kiwis to invest in arguably more productive assets, Kiwis invest in property, right? And if the property market isn't going, really the economy isn't doing too well, right? And I would say that towards the back end of this year, start of next year, you're going to see things really take off.
Do you see Chris Bishop's comments about we don't want house prices to go up?
No.
Yeah, so one of National's speakers, Chris Bishop, was like, we're planning that house prices aren't going to go up. Some people might not like it, blah, blah, blah. And I was just like, how are you going to actually do that? Like, if you look at the fundamentals of the property market, right? And going, house price, like if you look at all of the signs, right? House prices being down for a period of time, interest rates being high, which makes it a lot tougher. We're not building any houses. We've got more people coming to into the country. We've got all of these changes happening from a tax perspective. And then there's that pent up demand, right? I'm sure you could talk about the amount of clients who want to go and do something, but are like, I don't want to sell in the current market. I'm going to wait till things are a little bit better. Then I'm going to go and move.
Yeah, I find that a really interesting comment. I don't like really any or much government intervention in markets, especially markets where risk is priced in, and risk is priced into the property market. And, arguably, from my perspective, this intervention is a positive intervention. However, it's still an intervention in the market. It will still create an externality somewhere, negative or positive or unintended. And I think that a comment like that, which is we don't want house prices to go up, is very short-sighted. And for everyone in the comments who's like, you just want to get rich off property, it's an easy asset, you don't know what you're talking about. The property market in New Zealand is used to fund the majority of small businesses, and most companies in New Zealand are small businesses. And that is both the equity and the interest rates that impact the productivity of those small businesses, right? A lot of overdrafts are tied to a house. A lot of business loans are tied to a house. And as interest rates go up, those businesses become less profitable and less economic, which has a real flow-on effect into the country. So, yep, I guess he's making some headline statement, but I think that's a really dangerous thing to say.
Yeah, and I don't want to have a crack too much about
I
politicians, but if any politician says they actually don't want house prices to go up, I think they're lying, because what happens when house prices go up? We feel better, we feel richer, the economy moves faster, like you alluded to. Mike, let's switch the topic. Let's talk about interest rates a little bit, right? So we're talking about LVR changes, so the equity piece is one factor. What's happening in terms of interest rates? Before we move on, we talk all the time about planning and growing our wealth, but protecting that wealth is just as important. That's why having the right insurance in place can help when life goes unexpectedly.
And that's why this episode is brought to you by Partners Life, a New Zealand-operated, award-winning insurance provider with over 300,000 Kiwis insured and 89% of claims paid.
Partners Life understand that having some insurance is better than having no insurance. They have flexible and personalized solutions for any budget or situation.
Check out their website in our show notes below. Yes, interest rates are still slowly trickling down, and
could they trickle a bit faster, Mike?
Yeah, wow, couldn't they just? They're trickling down basically based on international overnight money markets. They're not falling based on the official cash rate or the Reserve Bank, because that's been held the same at 5.55, maybe I think it is, or something like that. But, end of last year, start of this year, we are low 7% for a short-term fix. And I'm only going to quote short-term fixes here, because if you're fixing for 5 years at the moment, you're an absolute idiot.
Why are you an idiot?
Because we are near the top of the interest rate cycle, probably a little bit past the top of the interest rate cycle. So effectively, you want to fix for shorter terms when interest rates are high, and you want to fix for longer terms when interest rates are low. Lock in lower for longer, get rid of shorter quicker, or higher quicker, right? That's a really easy kind of thing to do. However, we get some people who are fixing for like 5 years because their dad told them to fix for 5 years. And I'm like, I'm not going to do that for you. You're going to have to go to the bank and do that yourself. Because I don't want that liability of someone coming back to me in 6 months and being like, oh, Mike, interest rates have dropped. Why am I on 5 years? So basically, short-term interest rates are still trickling down. A really positive thing for the property market, the economy, for Kiwis in general. So I think that as that continues to trickle down towards the end of the year, we've talked about other positive things in the market, LVR changes. We're having some triple CFA rollbacks, a couple of other things around tax. That really is a great starting block for the property market end of year.
I've heard you talk in the past about the banks being greedy, funnily enough, very out of character for them. And
the banking racket?
Yeah.
No.
And them not passing on, interest rate, cuts when you're talking about money markets when the rates are dropping. Are you still seeing that?
Well, yeah, but that's their business, right? And they can sort of justify it the same way that, I guess, well, they always find a way to justify it. If it's not the 1 year rate, you got to look at the 2 year rate. If that drops, they're looking at the 10-year rate. If they're looking at that, it's the, I don't know, some other interest rate that they'll dream up out of nowhere to look at. And that's the one that we're actually looking at, not this one. So, and pricing money and funding a bank is a really complex operation to a degree.
You get some money, you chuck a margin on. Is it more complicated than that?
Well, only with the capital requirements that you need. That's really the thing you got to balance out. Buying money and selling money is quite a simple thing. But they are pretty slow at passing those cuts on. Again, they'll find any way they can to justify it. But yeah, we have seen some real drops in the overnight rates, and they haven't been passed on to customers. Not surprising though.
What do you think about? So
actually, and the way you can see that is the break costs on loans is because the actual headline rate hasn't fallen, but you'll go get a break cost say on Monday, and the interest rate's the same on Friday, and you go to get another break cost and break cost calculation, you'll see that there's a break cost on there now. So the price of money has fallen in the background. The headline rate is the same. The customers are going, why is there a break cost on a Friday but not on a Monday? Well, actually, it's because the price of money has dropped.
Haven't seen break costs in a while.
Yeah.
Interesting. And there'll be a big topic over the next couple of years.
Break costs are going to be huge over the next couple of years. And you really saw this 2009, 2010, where there was some huge break costs. A buddy of mine got some advice from a banker when he bought his first house, and they fixed on 9% or something for 4 or 5 years. And I remember it was him and his brother bought their house, and they had a fight, and they were trying to get out of it, and they literally couldn't. It was like a $40,000 break cost or something. It was crazy.
Yeah, and you allude to it, but just to break it down a little bit more, what is a break cost?
Cool. So a break cost is when you have a fixed interest rate loan, and let's say you fix for 3 years, and you get a year into it, and you go, I don't want to do this anymore. Either I want to break the loan and refix on a lower rate, so break that fixed term, or I want to sell the house. I mean, you repay the money, so you break the loan, or I've won lotto and I want to repay the loan, right? And I'm in any of those examples, you are paying the loan off or breaking that fixed term. If the bank can't go out and resell that money in the money market for more and make a margin on it, they will charge you the difference. So you don't get the premium paid back to you, but they will charge you if there's a loss on it for them. And that's what a break cost is.
Cool. Okay. Last question for you. So we had Chief Economist for Kiwi Bank, Jared Kerr, come on a couple of months ago now. We're going to get him back on very shortly. There was the sentiment that, November will be the time where we'll see a OCR cut. We'll be back within the inflationary band of 1% to 3% set by the Reserve Bank.
Yeah.
We're now in July and it still feels very tough out there. We're seeing more redundancies, more pain. Do you think that OCR cut is coming in November?
And it's a really interesting way that you've asked that question, James. So I'm going to answer it straight up. Yes, I think the official cash rate cut is coming in November. The interesting psychological thing is you've said it feels really tough. It feels really hard out there. It doesn't feel like we're getting anywhere. That is exactly what the Reserve Bank wants. So that's why I think 100% it's going to happen in November. If I'm wrong and it's in February, the start of next year, boo-hoo, I'm a couple months out, but I'm still hanging my hat that it's going to be end of the year, November.
Yeah, the problem is the lag in data, right? Like the inflation number we're going to get this month in July, and that will tell us a story, right? We're at 4%. Where will it sit at that point? That will probably give us a good idea.
I mean, the real problem is actually the fact that they overcooked the stimulus a few years ago. But yes, one of the problems that they are facing is that they have a real lag in their data. And I don't know if they're doing anything about it, but it is at least 3 months old, basically, every time they're making a decision on it.
Yeah, because when you're talking to clients at the moment, are you feeling that pain?
Yeah, absolutely, right. And the frustrating thing is I'm asking them to fix for 6 months and I'm advising them to fix for 6 months, which is the highest interest rate. So I'm saying, I know that you're feeling pain. I'm asking you to feel more pain, which is weird, with the bet that I am right and we'll be cutting end of the year or the start of next year. And, that's sometimes a pretty difficult call to make. But yeah, I firmly believe that that's what's going to happen. So that's the advice I'm giving.
Awesome. So in summary, the property market is not going to go crazy with one change in isolation, going from 35% deposit requirement to 30% deposit requirement. But when you look in totality of all of the changes happening from a tax perspective, inflation starting to come down, deposit requirements changing, it is showing a lot of signs that we will see movement in 2025, or at least that's what I tell myself so I can go to sleep at night. So when you are thinking about your own situation, do not sit there and go, I can't do anything, or now's not the right time to do something. Talk to somebody, whether it's a financial advisor, whether it's a mortgage broker. Definitely don't talk to Crazy Bob at the barbecue, but make sure you are taking action for your future, working out what should I be doing? Am I going to buy my first home? Is now the right time to buy an investment property? Or even before you go, I'm definitely going to do this, there's always the question of what can I do?
Yeah.
And I think that's where a lot of people get stuck is they can't separate the two. They think having a discussion with a mortgage broker is buying a house.
Yeah.
But the very first piece is going, can I do something or not? If you go, no, go and save another $10,000, it's a pretty short discussion.
Yeah.
But if it is, yes, I can do something, then maybe you start looking at some properties, you educate yourself and see where you end up.
Yeah, 100%.
Okay, we're going to wrap this one up. Thank you very much to Partners Life for sponsoring this episode. Make sure to subscribe, give us a review and a like for the hottest tips on financial education in the market, and we will catch you next time.
Cheers. On this episode, we talk about interest rates and my predictions and what I'm advising customers to do generally. Quick note, this is not personalized financial advice, and if you do want some advice on your situation, click the link below to book in and speak to us.